Welcome back. In this business finance lecture, we will go over study problem 10-4 in page 336 from the 8th edition of our textbook. Here's a view of the problem. So let's highlight some of the givens in the problem. A company is considering a major expansion, and that expansion will generate significant cash flows for the firm. The expansion requires a $1.95 million initial investment, and in return, for the next 6 years, the project will generate $450,000 of free cash flows. If the required rate of return is 9%, is this a good project for the firm? To answer this question, we need to figure the net present value, profitability index, internal rate of return, and then based on these figures we should be able to get a decision whether the project should be accepted or not. So to begin with, we will consider the net present value, and we will use the second row of our financial calculator. Recall that to make these calculations properly, you should have a Texas Instruments TI BA 2 Business Analyst 2 Plus calculator at the minimum. Okay, so let's start with the net present value. Here's an algorithm that shows each data key input that you should enter into your financial calculator to generate the result for the net present value. So let me also remind you to reset your calculator before you begin any new calculations. And recall that to reset your machine, you need to press second, reset, enter, and then second compute. 5 keys. Okay, so now in order to answer this question, we first press our cash flow key. That would be the second key from the left on the second row, and the display in your calculator will automatically show this. And then you enter the initial outlay of $1.95 million. Do not forget to put a minus sign by pressing the plus minus key, and then please press the enter sign. The output, the display of your calculator in this time will show this. Now be careful, because you inputted this value, it will also show a triangle, a side leaning triangle. So that triangle shows you that you entered this properly. Then you press down key and then start entering the free cash flows. We know the amount, so we enter the amount and then we press enter. The display now will present this. Again, you will see a sideways leaning triangle, and then we will have to keep repeating this 6 times. But before that, what I can do, I press down, and if I just say 6, the calculator will understand that for the next 6 years the project will generate $450,000 returns. So the display of your calculator will show as a result 6. Now in the final step, you press MPV. The calculator will ask you to enter the IRR value, which is 9 in our case. We press 9 and then we press enter. This is the display that will show up next, and then you press down compute and you can get the net present value. So this is the net present value of this project is greater than 0, and as such it is acceptable project. So the company can go ahead and accept this project based on the NPV. Now let's have a look at also the profitability index. Recall that profitability index is obtained by adding back the initial outlay to the net present value. So we can say net present value plus initial outlay, all divided by the initial outlay. So as a result, the profitability index in our example will come out as the net present value of $68,663 plus the initial outlay of $1,950,000, all divided by $1,950,000. So doing this calculation, the profitability index comes out as 1.0352, and again this number is greater than 1, and as such the project is definitely acceptable. So in part C, the question is asking for the IRR of the project. There are actually two methods to generate the IRR. One method will be to stick with our financial calculator. You already entered all the cash flows up to the blue line that I'm drawing right now. So what you can do, you can go back to your display of your machine, press CF, and then by pressing the down and up keys, try to find out that number again, so this display again, and once you have that display where it shows F01 equals 6, this is the last line of your free cash flow inputs. What you will be doing is that you will press IRR compute. So that's amazing. Just press IRR and then the compute key, and it should automatically give you the IRR of the project. In our case, it should come out as 10.17%. And again, by just looking at the magnitude of the IRR, because it exceeds the 9% required rate of return, so we can confidently again say that we are supposed to accept this project. An alternative second solution would be to use the third row of our financial calculator, something that we are very familiar with, and I over Y, PV, payment, FV. Now recall that this project requires a $1,950,000 initial outlay, so don't forget the minus sign, and then there will be a stream of payments received by the firm. As a result, those payments are $450,000 each, and then there will be no future balance on the project, has no salvage value, so the project will last for 6 years, and we are supposed to compute the I over Y, and sure enough, in computing this value, sure enough, we get the same result, 10.17%, as we got previously. So the two solutions are equivalent. So regardless of employing the methodology of NPV or profitability index or IRR, internal rate of return, the answer does not change and the project needs to be accepted. So that solves the problem, and we are done with this lecture.